Bismillah ar-Rahman ar-Rahim. Let's do this exercise. We have a company, Gas and Laila Power Company has been formed. A record of the first year operation includes, and we have several items, what happened in the first year of this company. The numbers given, you can say, is in dollars, in thousands of dollars. So we have, for example, sale of common stock, sale of preferred stock, sale of bonds, purchase of equipment, and then customer deposits are there. Purchase on fuel is there on credit, and then fuel inventory is consumed. Then billing for sale of electricity is done, and cash collected from sale of electricity. Wages are there, payments for fuel is there, depreciation of assets, interest payment to bondholders, preferred stock dividends are given, common stock dividends are given, and tax is also paid of 30% of the taxable income. This has happened, and now we are asked to construct balance sheet, income statement, and cash flow statement. So what I will do is I will take this to OneNote, and we will make a working sheet to make the balance sheet, and from there on we can make the consolidated balance sheet, consolidated income statement, and the cash flow statements. So let's move to OneNote. So here we are. We have a worksheet over here. We can see that you have assets, and then we have liabilities and owner's equity on one side, and assets on one side, and then we have all the items I have mentioned over here. It is on the right side are there. So let's go item by item, and we try to fill this worksheet here. And we have put all the items here. We have plant, we have depreciation, cash, materials, and account receivables under assets. And under liabilities and owner equity, we have common stock, preferred stocks, long-term debt is there, accounts payable, customer deposit, and profit and loss. Profit and loss, we can say account or retained earnings. Remember that retained earnings, these retained earnings go into the balance sheet. The link between the income statement and the balance sheet is the retained earnings. So whatever is retained is go to the balance sheet at the end of the year. So let's see. First is the sale of common stock, which is $1,000. All right, sale of common stock. Now remember that we said that balance sheet is a double entry bookkeeping. So any transaction occurs, we have to see that there is a double entry, and we keep the balance sheet balance. So first thing is sale of common stock, which is $1,000. Then we add over here 1,000 that we have sold these stocks of $1,000. So this has become a liability to us, and of course it's a double entry bookkeeping. Then we got cash here. Okay, so there is a liability here of 1,000, and then there is a cash we got. Then the second item is sale of preferred stock, which is of 500. So the second item is 500 here, preferred stock, and again we got cash. All right, sale of bonds 1,000 at 5% interest rate. So we have 1,000, which is long-term debt. Sales of bond is a long-term debt, and we can put it is 1,000. So here we put, we put here 1,000, and then again we got cash here. All right, then the next item is purchase of equipment, generation, transmission, distribution system, 2,500. So Now what we have done is we purchased it and it is through, let's say, is from cash. So the cash will be decreased. We make it 2500, make it decrease, that is negative. In parentheses we put anything we put in parentheses is negative. And we got plant worth of 2500. So now this is again balanced. Then the next item is customer deposit, which is 50. So we have made a account of customer deposit. We make it 50 here, and of course we got cash with that. Let's look at the next item is purchase of fuel on credit. It is 200. Purchase of fuel on credit is 200. This means that we bought something on credit. It's account payable then so we put 200 here. Okay, and what we got fuel, so material we got, and that is what? And that is an asset. So we look at that, we go to there and we fill this one 200. All right, then the fuel inventory is consumed 170. 170 is consumed. It's an expenditure. And the fuel inventory is consumed, which means that materials has become less. We say 170 is used up. Now it is used, it's expenditure. So we have a retained earning or profit and loss account here. We put 170 as expenditure. All right. Then we have the billing for sale of electricity, which is 700. Billing for sale of electricity. Now at the moment we didn't get the cash, we sent the bill. This means it is account receivable. Account receivable is there, and we put over here, this is account receivable. Now billing is done. When billing is done, it is considered as sales or revenue is generated. Regardless whether we got the money or not, that is not our concern, because expenditure is done, the revenue is generated through expenditures. So we say that we have confirmed this, that 700 has been or will become to us. So this is our sales or revenue, 700. All right, it is recognized. The next item is cash collected from sale of electricity, which is 690. Now we sent the bill and we got the cash of 690. This means that the account receivable now will be reduced by 690 because we have got the cash, and of course at the same time we got the cash. So we reduce over here 690 negative, and we got cash 690. So far we are balancing it, it's going well. The next item is wages. Wages is 120. So we have given the wages. It means that the cash has been reduced. Okay, the cash is reduced by 120. And wages is expenditure. So we put it in the retained earning column here. We put here we put expenditure. Payment for fuel is 180. Now remember that we bought the fuel on credit, Now the payment is done. We got accounts payable was 200. Now we have done the payment, so 180 is now reduced. The liability is reduced by 180, and we have paid it, so it means that it will be reduced from cash also. Okay, then depreciation of assets, it is 130. Now remember that we said that depreciation is charged or against the revenue, it is an expenditure, so it will come under retained earnings. So we say depreciation has occurred here of how much? 130. So we put 130 here as an expenditure, and then we go here and we have a column for depreciation under assets, so we put 130 depreciation. The next is interest payment to bondholders, it is 50. So we paid the interest, and again this is an expenditure. We say 50 is gone from our pocket, or expenditure is there, and of course the cash is gone from our pocket. Preferred stock dividends. Preferred stock dividend is 35. We have given the dividend, so it's an expenditure again, and 35 is reduced here also. And then the common stock dividend is 80. Again it is expenditure here. We have given the dividends, and the cash is reduced by 80. The next is tax is 30% of the taxable income. The taxable income is the income after the it is basically earning before interest and tax, and then EBIT, and after EBIT we give the interest, and then this become a taxable income, which means that taxable income will not include the interest, but the rest of the things will be there. Okay, so we have this account, profit and loss account or retained earning account. From here we can calculate what is the taxable income. So let's say taxable income is then equal to, we have the revenues here 700 minus this 170 fuel consumption expenditures minus 120 is this wages. Okay, then minus 130 is depreciation here, and then we have interest. Then after paying the interest it becomes taxable income, so we have minus 50 also. So this total is, so this become taxable income becomes equal to 230, and tax is 30% of the taxable income. Then 230 multiplied by 0.3 will give us the tax. So we got tax then is equal to 69, which is 30% of 230. Okay, let me 30% of taxable income 69. So we put 69 here. This is given as an expenditure, and of course we have the cash gone here, and that's it. We have filled all the items. It's just now we can add all these items here in the total. So we have plant is 2500, depreciation is negative 130 here, and then we have cash. Now if we add all these items under cash, what we are getting is 206, and then material is 30, and then the receivables, account receivables are 10, and then common stock. Okay, this is now the other side. Common stock is 1000, preferred stock is 500, then long-term debt is 1000, and then we have account payable is 20, and then customer deposit is 50, and this profit and loss or retained earnings coming is 46. Now the assets must be equal to the liabilities plus owner equity. So we have, if you add over here up to here, this is assets, this becomes 2616, and from here to here again it is 2616. So we have a balance sheet balanced. Now this is worksheet. We have done the worksheet. Now we have to make a consolidated balance sheet. The consolidated balance sheet is down here. We can just fill up the things we have got here. We just have to fill these numbers here. So we got fixed assets, which is the transmission distribution systems. So generation, transmission, distribution system, we have 2500 here, and depreciation is 130. If you like, you can check. This is 130 is coming as a depreciation. The net fixed assets are then 2370. The current assets, we have cash. Cash is 206, and then we have the materials. The material is 30, and then account receivables are 10. So this becomes current assets, become total current assets are 246 to 246. Then the total assets are 2616. Now let's work on the liabilities and owner's equity side. We have common stocks. The common stocks were, if you see, 1000 are there, common stock. So we have 1000 here. Then we have retained earnings, the last item, 46. Okay, and then preferred stocks are 500. So this becomes total equity, which is 1546. Then we have a long-term debt, which is 1000. Payments of not payments of the bonds which we have bought, we have sold, sorry. So this is 1000, and then we have the current liabilities. The current liabilities, accounts payable. Account payable are 20. The customer deposits are 50, and the total current liabilities are then 70. And total liabilities and owner equity, if we add this column here, we get 2616. So this is our consolidated balance sheet. Let's look at the consolidated income statement. Now, income statement, if you like, it is, we have already got this in the retained earning or profit and loss account. This is our income statement, but we will write it down in a nice way over here. The revenues we generated is 700. Please note again that we only got 690 in cash, but as we have done expenditures to generate the revenues of 700, even though we have not get it, but it will be recognized that we got it, so in the income statement. So 700 is revenue. And then we have fuel and material, which is 170. Consume, expenditure, wages was 120, and then we have depreciation. Depreciation was 130. Then earnings before interest and tax, that's become 280. EBIT, earnings before interest and tax. And then we paid interest, which is 50 here. And then income before tax. Income before tax is then 2. Okay, interest is negative again here. Then income before tax is then 230, and the income tax is 30% of that. We already calculated that, 69 here. All right, and this is again negative. The net income becomes equal to 161. On the net income, we paid the preferred stock dividends, which is 35, and then common stock dividends were paid, which is 80, and then annual retained earnings we got 46. This is our consolidated income statement. So next we move on to cash flow statement. The cash flow statement is simple equation for that is that net cash is equal to cash inflow minus cash outflow. Or the sources of cash minus the application of cash or uses of cash. And actually we got this from here. This is our cash, and it has all the sources of cash and also the application of cash, and finally we got 206. But the companies, they do not present like that what is the cash inflow coming and cash outflow coming. Mostly the company present it with indirect method, and the indirect method is using this equation here, that assets are equal to liabilities plus owner equity. So let's look at that, how they present it. They presented the cash flow statement under 3 activities: operating activities, investing activities, and financing activities. And they are presenting it with indirect method. Indirect method is using this equation here, that assets are equal to liabilities plus owner equity. So we have on the asset side we have plant minus depreciation plus cash plus material and inventory plus accounts receivables, and they are equal to common stock and might use this one. Common stock plus preferred stock plus long-term debt plus accounts payable and plus customer deposits plus retained earnings. And from here we can indirectly work out what is cash. Then cash is equal to all the things on the right side, and then the things which were on the left side will go to the right side of the equation. The signs will change. So we have cash is equal to all this owners plus owner equity plus liabilities is up to here is the same, and then we bring this material and inventory is become negative when goes to the other side of the equation. Account receivables payables becomes negative, plants become negative, plant or equipment become negative, and depreciation become positive. Further, the retained earnings, because the presentation starts from net income, so we can split this retained earnings into net income minus the preferred stock dividends and minus common stock dividends, which we can show that net income will be positive and preferred stock dividends and negative common stock dividends are negative. So we start from here. The net income, and we can see from net income is in the income statement 161, so we write down 161 here. Depreciation is 130, and according to the equation shown here, indirect equation here, indirect method, it is positive, and that makes sense also, because depreciation, although it's a charge against the revenue, but it's not the cash flow. The cash is with us. So 130 is added into it. Accounts receivable, and if you look at the equation again, account receivables are negative here. If you look at that, they are negative, account receivable. And we go back here. So account receivable, and account receivables were 10, so we show negative 10. Accounts payable are positive and they are 20, and they are also making sense because you can see that account receivable we didn't receive the cash. So although it is in the income statement, this was added, this 10 was added because 700 was the bills which were sent and we received only 690. So 10 was accounts receivable, and this 10 is not a cash we got. So we are subtracting from the net income. And accounts payable, on the other hand, we didn't pay it, so the cash is still with us. So 20 is positive here. Inventory and material, if we look at the equation again, inventory and material is negative. Inventory and material is negative, and this is negative, so which means that inventory and material was how much was the inventory and material? It was 30. So we show inventory and material 30. Customer deposit is positive and it was 50. So the net cash provided by operating activities is equal to, if we sum all these, we get 321. Investing activities, purchase of equipment, again go to the equation, it is negative, plant is negative in the equation from cash. If we look at the equation down there, okay, the plant is negative here, so this is plant here, negative. So we put purchase of equipment is 2500 negative, and the net cash provided by investing activities is then negative 2500. Financing activities, we have sales of common stocks positive. We sold $1,000 or $1 million, and sales of preferred stock is 500, and sales of bond was 1000, and common stock dividends, the dividends were given 80, and now we are saying it is negative. So if, for example, net income minus preferred stock dividends minus common stock dividends is retained earnings. So here we have started with net income here 161. So here the common stock dividends are then negative 80 and 35 are the preferred stock dividends. And if we add all these financing activities, we get the net cash provided by financing activities as 2385, and net change in cash is then, if we add the second column here, we get 206. Beginning cash is 0, assume it is 0, then the ending cash will be 206, and that's how they report in the cash flow statement by indirect method. Again, you can see that we got 206 here, and it is the same amount we got with the direct method. The direct method is cash inflow minus cash outflow is the net cash, which is coming over here as 206. So that's how the cash flow statement is reported under three activities: operating activities, investing activities, and financing activities using indirect method. One may ask a question, what about, we have shown common stock dividends and preferred stock dividends, but we didn't show the interest paid. It is actually under net income. It is already buried there, because net income is after we pay the tax, then that is the net income. So it is already buried there. That's why we didn't take into account that the interest paid to the bondholders. Some organizations, some companies, they prefer to put common stock dividends and preferred stock dividends as under operating activities, but most of the companies, they show it under the financing activities. But whatever way we want to show it, we have to be consistent. It is not like that in one year we show it under financing activities, and another year the company show it under operating activities. If it is showing it consistently, then it's fine. Most of the in United States, the practices that the financing active and common stock dividends and preferred stock dividends are shown under financing activities. That's all we have. So what we have done is we were asked to prepare from the given transactions for this power company. We were asked to construct the balance sheet, income statement, and cash flow statement. We started with working with the worksheet, and from this worksheet we made the consolidated balance sheet. Consolidated balance sheet were made, consolidated income statement was made, and the cash flow statement was made from indirect method, using indirect method, showing it under different three activities: operating activities, investing activities, and financing activities. Thank you very much.